We are delighted that you are joining us today to talk about nothing else other than FINRA and the SEC's recent best interest cases, and more importantly, how you can protect your business as it relates to these best interest a crackdown that we're seeing. A quick housekeeping item. We are recording today's conversation and plan to share it with you following today's session. In addition, this webinar qualifies for an IACCP CE credit. So if you are a designee, please send the confirmation of your attendance to the IACCP Resource Center, and you'll be sure to get that credit. Secondly, you can engage our panelists. If you have any questions throughout today's discussion, please use the chat prompt at the bottom of your Zoom screen to submit any questions throughout today's discussion. And by the way, we have allotted 15 minutes at the end of today's session to take up any questions that you may have. Let's jump into introductions and our esteemed panelists. If I could kindly start with you, Erin, if you don't mind introducing yourself.
Sure. Hi, good afternoon, everyone. Thanks for joining us today for this webinar. I'm Erin Preston. I'm the Chief Compliance Officer and AML Compliance Officer for Wedbush Securities. I'm happy to be here with my panelists and looking forward to the conversation. Thanks, Parm.
Thank you, Erin. Mr. Sarabi.
Yes. Hi, everyone. This is Armin Sarabi. I am the Managing Director at Bates Group. It's a pleasure to be here today. I'm really looking forward to this conversation. And thanks for having me.
Thank you, Armin. Isa.
Hi, everybody. Thanks for joining us today. My name is Isa Hanna. I'm a partner at the law firm Evershed Sutherland. I am located in our New York office, and I sit on our investment services team, which supports broker-dealers, investment advisors, insurance distributors, and private fund sponsors in various regulatory matters. And I'm happy to be part of this panel and part of this discussion. Thanks for having me.
Thank you all for being here. And for folks who haven't met me, my name is Param Desari, and I'm going to be your host / moderator for today's conversation. And for those who have not come across InvestorCom, we are a leading software provider to wealth and asset managers across North America. And our award-winning platform, not just platform, our award-winning platform is known for its intuitive solutions that help eliminate compliance risk and foster growth for your practice. With that wonderful introduction, let's jump into the purpose of today's conversation. And we're going to start off with a quick scan of the insights our panelists are seeing in the marketplace. What are they seeing? What are they expecting under the current environment? We'll then zoom into a couple of cases we've seen that have come across our radar. We're going to try to cover 4 specific cases. And finally, we'll review what firms can do to effectively mitigate these risks and regulatory scrutiny effectively to protect your practice as we go forward. And as always, please feel free to submit any questions that you come across in today's session. Let's start with that environmental scan, and maybe I can begin with you, Isa. From what you're seeing by way of recent cases and across your client base, the SEC and FINRA are increasing their enforcement activity, specifically around some of these best interest principles and requirements. Any key trends that have come across your radar?
Yeah, absolutely. I've been just overall kind of keeping track of what's been going on with the SEC and FINRA's enforcement cases over the last several years relating to Reg BI. And you could definitely see that there's been a shift, both in terms of, the nature of the cases, but also in terms of the subject matter. Sorry, not just the subject matter of the cases, but also the amount, the sheer number of cases. So I would say when enforcement first started with respect to Reg BI, and also with respect to Form CRS, the focus was much more on low-hanging fruit. Things that were very basic, like whether a firm adopted policies and procedures at all to comply with Reg BI or Form CRS, or whether a firm kind of complied with a black and white requirement under Reg BI or the Form CRS rules, like delivering the Form CRS at all, or just having a Form CRS filed with the commission um, on the CRD. So it was more kind of low-hanging fruit, black and white type of stuff. But then a couple of years ago, I would say things really shifted. And this was the case, I think, with respect to both FINRA and the SEC approach to the requirements. And now the focus is very much squarely on the care obligation and the associated compliance obligation requirements. And, I would say overall, the nature of these cases under the care obligation can be, bucketed into like a few broad areas. First, I would say there's definitely been a trend, especially recently, where the regulators are questioning account type recommendations, those types of gating issues, particularly with respect to brokerage versus advisory, and whether those recommendations of that account type, an advisory account versus a brokerage account, was necessarily in the best interests of particular retail customers. The second broad area that's been kind of hot has popped up in the with respect to alternatives and with respect to complex products. And that's really the focus there, I think, has been more on allegations that the firm did not necessarily conduct a reasonable level of diligence to understand the products that they were adding to their platform and making available to their retail customers before before recommending them. So that's like one other broad area. And you'll see that pop up particularly with respect to private funds. And then, the third, I guess, broad area that they've been focused in on is in connection with complex and costly products, and, like going after firms for not conducting a sufficient reasonably available alternatives analysis in that context to determine whether there might have been a less complex or less costly alternative that was available to the retail customers and may have been a better choice. So that's broadly speaking where things have kind of shifted. And then I would say overall, just kind of doing a little bit of crystal balling as to how things may go in the future. Given that there's already been, so much of a focus on account type recommendations and those types of gating issues, that in combination with the fact that, the DOL's latest attempt to kind of implement and strengthen their, latest efforts to, revisit their fiduciary rule have kind of stalled out and haven't necessarily panned out the way that they expected. I would not be surprised if the SEC and FINRA took up the mantle with respect to rollover recommendations and started, thinking about, well, are firms considering, the best interest of clients when making rollover recommendations. So I would look out for that as another area where, the SEC and FINRA could get involved now that there's a bit of a vacuum from a regulatory perspective with the DOL's rule being vacated. So that's generally where I see things at this point, the general lay of the land.
Thank you, Issa. That's awesome. You've definitely highlighted a couple of the key items that we'll talk a little bit later as well in terms of account recommendations and the cases we've seen. Now, Armin, let's sort of tag on to that scenario where an investigation is being conducted or a firm's going through an exam. what do you say to your clients? What are the first steps they should take to strategically comply from a regulatory perspective? Like,
Yeah,
there you
I would say that the first thing is just don't panic, right? These things are examinations are they always say there's a couple of guarantees in life is death and taxes. I think exams are probably one for us. So you don't want to panic and just want to take a methodical and strategic approach, with it. I would say, really first and foremost, you want to designate a response team and specifically appoint a primary point of contact so that all communications are going back and forth through that individual, but you've got a designated response team who's able to peel away from the day-to-day activities of the firm and be able to focus on, addressing the inquiry. And I would say if you have an outside consulting firm, this is the time that you want to engage them. I'll actually add, I think honestly, it's best practice, and I would really recommend that every firm out there at least have a contact with a outside consultant. A lot of firms like to even keep somebody just on retainer. Maybe they don't have an ongoing engagement, but they buy a block of time that they can tap into when something like this comes up. But you don't want to be scrounging around interviewing a consulting firm to help you when the exam letter comes. So it's always good to have a good relationship on hand that you can reach out to. And Bates Group is a great example. There's plenty of other firms out there that do the same thing, but it's a great resource, and we see exams all the time, so we can help you have that crystal ball, if you will, and have a better understanding as to what what the inquiry is about, whether it's unique to you or if we're seeing sweeps take place and things like that. So there's benefits to doing that. Outside of that, I would say, you want to be really careful about how you review the inquiry letter and make sure you understand what they're asking for. And really once you have a good grasp of, what the request is and what the direction is that the regulators are going, that's when you start really conducting your internal, risk assessments. And you want to identify kind of key, personnel or policies and procedures that might be tied to issues that are raised. And then look for gaps in those, in the policies and procedures where perhaps something that they're asking about, maybe your policies didn't address them properly. Something else that we don't often think about, but you really want to have a good approach to controlling the communications as well, both internal and external. So having a primary point of contact helps the external communications, but a lot of times these inquiries they take up a lot more of your resources than people realize. And your advisors, your clients, they may catch on to the fact that they're not getting the same level of services they were a few weeks ago. So it's good to be able to communicate to them in a way that's not going to alarm anybody, but just give them an understanding of the fact that you're going through a routine exam or even a targeted exam, depending on what it is. And then I would say you want your document production to be organized and strategic, right? These are just normal steps that really any kind of exam, it just helps to put your best foot forward. So to the extent that you can have clear, complete documentation provided, you don't want to over disclose. We always want to give just what they're asking for, and then make sure that everything's properly indexed and in a professional format, and review all the responses and submissions to make sure that there's consistency between what you're providing and really avoiding any kind of contradictory statements or documentation. Oftentimes we're just hurrying through this stuff, and you can kind of or if multiple people are producing information and it's not all kind of being reviewed at the end by a single person who can put a single voice to it, then there's a risk that you're going to potentially produce something that may look inconsistent, and that can inadvertently create raise red flags, which obviously you don't want to do. And then lastly, I would say, as you're going through all this, as you're looking at your policies and procedures, looking at the people that may have been involved and things like that, look, no one's perfect, right? And you're going to identify some red flags. Things are going to pop up and you're going to say, shoot, we probably could have done this better. So that's when I would say you want to designate a secondary team if you have the resources, so that in parallel to you addressing everything with the regulators, you can also have that secondary team remediate the issue that you've identified. There is definitely a benefit to taking corrective action in parallel and to self-remediation. Certainly there may have been some issues there, and the SEC or FINRA or whoever you're dealing with may or may not hone in on it. But at the end of the day, if you caught it and took steps to fix it, before before too much time went by, then that's always going to be a better look. So, I'd say that's generally a good approach to any type of examination that comes up. Obviously, you want to tailor this to some extent depending on the specifics of the examination.
Thank you, Armin. That's sound advice. Aaron, as Chief Compliance Officer, share your perspective. Are there any internal controls that need to be in place? What do you think?
Sure. So I think adding to what Armin shared with us today, from my perspective, good internal controls are in place well in advance of being notified of an audit, right? In a perfect world and subject to your resources, right? We're all being asked to do more with less. But here's a couple of internal controls from firsthand experience that we found are beneficial. The first is, a compliance testing program that's risk-based, right? That identifies, certainly in this environment, that Reg BI form CRS, depending on your products and clientele, should be near the top of your priority list, right? And you're performing that annual gap analysis of your policies and procedures and controls against the FINRA priorities letter, right? And they provide a number of factors, a number of findings every year, which is really helpful, as well as the SEC exam priorities. And you really want to do a gap analysis there, not simply looking at what they're calling out, but do you do these things, or do you potentially have these same issues, and making an action plan. And then you have proper governance where you're reporting on the state of your compliance program, the results of your compliance testing, any remediation items, and you're setting deadlines with your business partners to address those issues. So that's all going to happen ideally before you get to the audit. I think, another area that when you find out about the audit is, organizing the right stakeholders, the right team members, who the responses are going to go through. What are you going to do if you discover something during the audit? How are you going to address that, communicate that, and hopefully turn that around during the course of the audit so that you have, the best outcome. I think it's also having regular, controls testing, looking at your technology if you're using a vendor. I know that we use a vendor for our Reg BI compliance, and so you want to reevaluate that the vendor and the parameters in your technology service provider are working as you envision, and doing an analysis of your products, your services, your client base against those parameters in that system to make sure it's, reflecting current state and not what it was perhaps, 12, 18 months ago. So those are a few things that we found have been beneficial.
Thank you so much for that, Aaron. Now, let's go in that scenario, which is really kind of the purpose of today's conversation, and a scenario where an enforcement activity is taking place. Isa, when a firm's going through that enforcement action or investigation, what are some general mitigating factors to consider?
Sure. Yeah, I mean, without getting into any specifics, I would say overall, there are certain things that can prove very helpful in that context where, you're dealing with an aggressive regulator or a regulator that is asking, tougher questions. And, I would say overall, there are a few things to have in your back pocket in these circumstances, that you can kind of use for your benefit, and hopefully mitigate any risk of a referral to enforcement or significant enforcement action. So I would say the number one thing, given how much the regulators are focusing on particular recommendations, the care obligation these days, and specifically with respect to kind of these hot button types of recommendations, like account type recommendations, complex products, costly products. It's pretty helpful to have contemporaneous and well thought out documentation that kind of shows the basis for those kind of recommendations that end up getting commonly questioned by the regulators. So it doesn't necessarily have to be with respect to every type of recommendation or everything that kind of goes through your firm, but in connection with those particularly, you know, those recommendations that get a lot of scrutiny, have been getting a lot of scrutiny lately, or that just kind of raise particular conflicts at your firm due to, conflicted compensation arrangements or whatever, having that kind of contemporaneous and well thought out and thorough documentation is super helpful to have in your back pocket. I'd also say what's also very helpful and that shows good faith to the regulators is having, consistent governance processes that are, that are kind of thoughtful and that are kind of carried out on a regular basis. So, you know, a product due diligence committee, a conflicts committee that's, meeting on a regular basis, that's staffed with the right people and, that's focused on the right things, not that's really taking its time to kind of work through the you know the recommendations and the practices that present the most risk. So that's super helpful, and also obviously documenting what's going on via those governance processes. Your product due diligence, memoranda, should be you know uh, well kept, and then you should have obviously a conflict matrix that has certain uh, you know columns to it that keeps track of all your firm's conflicts, whether they're being disclosed, how it's being disclosed, mitigation practices, supervisory practices, et cetera, with respect to each one. And then, finally, policies and procedures are obviously going to be super helpful. And, they should go beyond generalities and get into specifics. Specifically when, there are, particular issues or risks at your firm, don't be, shy about, developing policies and procedures to kind of address those topics that are really kind of tailor-made or specific to your firm. If you're a firm that has, you know, um, for example, proprietary products on the platform, there should be, pretty specific policies and procedures that get to, how you're going to go about, ensuring that those recommendations of proprietary products are in, retail customers' best interests. So that's, those are my overall kind of, pieces of guidance for folks as they, look to kind of put up the right defenses, and in the event that they are ever questioned on anything.
Thank you, Isa. And now very many people that I know refer to these issues as hot issues. So let's jump into them. So Isa, maybe we begin with one of the major cases under the care obligation arm. And in October 2024, a firm recommended mutual funds without considering or without evidencing that they've considered lower cost clone ETFs. From a legal and practical standpoint, how should compliance teams approach assessing product recommendations more generally to demonstrate that they have their investors' best interests at heart?
Yeah. So, this clone ETF case, it seems that, the SEC, might be taking the view now, on the basis of this case that, clone ETFs are somewhat analogous to maybe an advisory share class in the context of those prior 12v1 share classes or share class sweeps, that started with the Mandarin case in 2013 and continued for several years after that. So, I think as a result, it might make sense to consider whether it's worth applying, previous policies and procedures that you implemented in response to those 12b1, share class issues on the advisory side to that broker-dealer context as well, but specifically tailored to clone ETFs. And, if you look at uh, the case that the SEC brought here, it seems that they are kind of staking out a position where if you have available on your platform a clone ETF that is identical to a mutual fund that's also available to customers, in that the ETF has the same exact investments as the mutual fund that it's cloning, and the clone ETF costs significantly less to hold, you could potentially have an issue. So whenever you're kind of thinking about adding that clone ETF, it's worth kind of going through that two-step analysis. Does a clone ETF hold the same exact investments, and is it significantly less expensive? If that's the case, then you want to kind of have consider whether to kind of kick those those policies and procedures into gear to figure out your path to ensuring that recommendations of the mutual fund version versus the clone ETF version on an initial and an ongoing basis are in the best interest of those retail customers. I'll also mention that SEC enforcement actions and any enforcement action, they can be ambiguous, and there's oftentimes certain pieces of the kind of logical puzzle that are not necessarily laid out in the most excruciating level of detail. So I'll say that there's kind of an open question still as to what significantly less or significantly higher cost is in this context. Specifically, what is the cost difference between the ETF and the mutual fund that merits taking action here? They didn't necessarily say in this case what the cost difference was that kind of led to the issue. And then there's this kind of perennial issue that kind of arose in connection with the line of cases that started with the Mandarin case in 2013 regarding the SEC's view about when a different investment or a share class or whatever is reasonably available. What makes something reasonably available? And they didn't get into any level of detail in the case about what made the ETF clones reasonably available in that circumstance. But it's fair to ask, well, is an ETF clone reasonably available if it's not necessarily on your platform, but you have to approach the mutual fund company or the fund company and ask them to add it? Is that reasonably available in that circumstance? That's kind of an open question, and I think a lot of SEC staffers would have certain things to say about that, and you might hear different views depending on who you're talking to. But that's those are kind of some things to kind of keep in mind. And then finally, in this case, the SEC kind of leaves open the possibility that a mutual fund clone could have theoretically been in the best interest, notwithstanding the lower cost. And that's, by the way, consistent with certain guidance in the Reg BI adopting release, where the SEC said they are not necessarily imposing a requirement that broker-dealers recommend the lowest cost alternative in all circumstances, and that they recognize that there are case by case or facts and circumstances that might dictate a best interest recommendation that is not necessarily the lowest cost recommendation. But in the enforcement action, the SEC does not detail what circumstances would lead to a best interest recommendation when the lower cost clone ETF is not selected. So these are kind of outstanding issues that are hanging out there after the resolution of this case, and we'll continue to watch them and see what happens from here.
Thank you, Issa. That's very thorough, and I see the questions coming in. We'll be sure to tackle those. I mean, in general principle, if there are lower cost alternatives available, I think either you sift those out up front, upstream or downstream, the advisor is able to see what they are, see what those options are. Speaking of which, Aaron, what are some indicators that firms should look at to flag these potential, I'll call them conflicts or areas of vulnerability when it comes to these issues, specifically as it relates to recommending potentially higher cost products when lower ones are available?
Sure. So a few things that we look for really start with kind of sorting the products on the platform into, their groups, right? So we understand that not every product is a one-for-one match. And we understand that there are certain relationships that we have with affiliates, and there are, obviously very different um, characteristics of these products, particularly when you're trying to offer these robust services that we do offer to our investors today. So what are some examples we look for? We look for higher cost to equity ratios. We have parameters set up that match the profile of the client based on their risk tolerance, their age, income, etc., to these products that we've identified as being higher risk. We're looking for concentrations of affiliate products being recommended by certain FAs. So why is this FA, despite a variety of clients, a very diverse set of clients, perhaps recommending this same set of products over and over and over again? So we're looking for a lot of those same characteristics that you might have applied back in the suitability days, but we've just become more sophisticated in our analysis and more sophisticated in terms of how we're using technology today to supervise and surveil.
That's excellent, Aaron. Thank you for sharing your insight from that perspective. I see some questions trickling in on account recommendations, and I think it segues into your point, Aaron. Let's jump into those two cases we've seen. And gosh, there's a lot of text on the slide, and we'll make it available to folks as well. But certainly, as Isa, you coined it, I'm going to pick on you for it. The hot issue tends to more so revolve around account type recommendations and account switches. Maybe if I could, Armin, let's start with let's put your former general counsel hat on. The March 2025 SEC enforcement case highlights the importance of assessing costs when it comes to account switches. Is this case a surprise to you? Any general observations?
Yeah, I mean, I think account switches, by themselves are not inherently a bad thing, right? And there's certainly lots of legitimate reasons why an account switch would take place. And I think this has been common practice, for a long time. Why we're seeing some of these cases today is obviously there's a heightened sort of scrutiny on these account switches, and the regulators really are focused on whether the switch is for a legitimate purpose that's in the best interest of the client, or if something else is going on. And I think that this is not necessarily a black and white issue either, in the sense that to the extent that there are enforcement actions that we're seeing, I wouldn't say that it was necessarily the result of an intent or willful bad action, but oftentimes we find that perhaps the intent was good, the execution wasn't, and what we see is that ultimately the firm didn't actually meet their Reg BI requirements, and the account switches weren't in the best interest of the client. So I don't think it's a surprise that it happens, and nor am I really surprised to see this that there's a trend right now. I think it's just a focus for the regulators right now.
Thanks, Armin. Isa, what are you hearing on these particular cases on account type recommendations from your perspective?
Yeah, I mean, I think these cases kind of hark back to certain guidance that's a little buried within the Reg BI adoption release, but it is nonetheless there. And the SEC gave some guidance back in 2019 about what a broker dealer in meeting its kind of its care obligation in connection with account type recommendations and those kind of gating determinations, what they should be taking into consideration. And they listed off 5 factors at that time. And to be honest, the cases are pretty consistent with that guidance. And what they said in the Reg BI adoption release is, when kind of thinking about whether a retail customer should be an advisory account versus a brokerage account, a firm should consider first the services and products provided in each account, including any ancillary services that are provided in conjunction with the account type, such as account monitoring services. Should also consider, number 2, the projected cost of each account to the retail customer. Number 3, alternative account types that are available. Number 4, the services requested by the retail customer. And number 5, the retail customer's investment profile. And then, the SEC at that time continued to say that with respect to those last 2 factors, you should kind of look at your client intake documents to try to ascertain whether the client or the customer is interested in some sort of ongoing advice relationship or active trading strategy, or some sort of transactional or pay-as-you-go model, where the former, with the ongoing advice and the active trading, would probably point to an advisory type of relationship, whereas a transactional or pay-as-you-go type of preference would probably point to more a brokerage account type of solution for that particular retail customer. So that's the guidance that's out there, and I would encourage folks to take a close look at that, particularly as they're thinking through the policies and procedures they may have in place to ensure that account type recommendations are in the best interests of their retail customers.
Yeah, I would add to that. You say thank you for going through that list, because it's a great reminder. I think just from a practical perspective also, just going back to look at this, and I see a question here. I'm going to jump in and just answer one since it's up there. But the person asked, what's the RIA only type firm, and how does the SEC's best interest apply in this? So look, I think one of the things we see pretty frequently now is that there are people who are leaving the BD world and going into the advisory side of things, and their clients want to transition with them, right? So this is a very natural scenario that happens, and a transition. And frankly, oftentimes that client will benefit from the advisory relationship, because they get a more holistic approach, and they want specific strategies to invest in, and things that may not necessarily be available to them in a traditional, transaction-based brokers type account. So, with all that said, I think where we're seeing a lot of these issues happen in that type of a scenario is especially with let's say bulk transfers of clients, right? So we just need to be careful to have the right supervision practices in place, the right policies and procedures in place to be able to address those things. And if you look at these cases, that's probably some of the trends that you're going to see is bulk transfers. There's not necessarily an individual account by account review to determine whether, based on the specifics that Issa read earlier, that we actually went through that analysis with the client and their account to make sure that the recommendation and the new account was in the client's best interest. And that's the issue. As a lot of times these things are moving so fast, business is moving fast. And if we don't have those controls in place at the onset to be able to catch these things and review them, then you can get in trouble. But I would say just practical guidelines, slow down, have some processes in place when there is a bulk transfer happening, review the accounts. And, especially if you're doing something like, switching accounts, or frankly, I would say look for complex products, look for mutual funds, look for things that have historically hit the regulator's radar, and do a quick analysis to see if there's a better option out there. Many of the larger custodians out there will work with you to be able to run that analysis. There's tools out there that are also available, lots of technology that'll help you with those things. But it pays to invest a little bit up front and do that analysis and identify the better solutions for the clients, and document those things and make sure that you can support your decisions. And frankly, I would say just having good policies in place to begin with. It's if you can identify how your firm is going to approach these things and then apply those policies across the board, then you've created some good supervision practices and all of that.
Thank you, Armin. on that point, if I could just interject with one comment, and the question was really around, well, does this really apply to RIAs? The case on the left-hand side is exactly that scenario where it is an investment advisory firm only, and the advice was to switch. I think it's 100, don't quote me on the exact number, but hundreds of accounts, hundreds of investors were en masse switched over from brokerage accounts to advisory. And so it doesn't necessarily need to mean that this best interest principle only applies to broker-dealer firms. It's actually also on the RIA side, and the first case, or the case on the left-hand side, is of that particular scenario. Now,
Yeah, can I just kind of mention one other thing, Param? I thought in that case it was important that the rep at issue was also associated with a third-party broker-dealer. And that kind of raised the stakes for the investment advisor, right? In terms of how deep they had to go to consider, whether brokerage or advisory was in the the retail, clients or retail customers' best interest. So, in a case where, you're an RA only firm, your people are IAR only, sure, you don't, your process to kind of consider, brokerage for advisory, should be, should not necessarily, it's probably not going to have to be as involved, I guess, to kind of, because what you're comparing against is really, in theory, brokerage as opposed to a specific brokerage account that's actually available, right? But I would say in general, as an investment advisor, in those circumstances, even if your people are just only wearing that IA hat, there should be policies and procedures in place, to ensure that your people are only recommending that advisory account, generally speaking, when it's overall in that retail client's best interest based on their particular circumstances. Did they, in their profile, or did they kind of indicate in their kind of specific, intentions that they wanted those kind of basic things associated with an advisory account, an ongoing relationship, frequent trading of their account, those types of general themes. That should all be kind of part of the mix when you're trying to determine, is this person a good fit for, an account with our firm? If that's not there, I think, you have a real issue. So I would say you're not necessarily off the hook, just because, you don't have a broker dealer in the picture. And I'll point you to, in particular, specific language in the 2019 Investment Advisor Fiduciary Duty Interpretation, where the SEC says that account type recommendations and rollovers are subject to the investment advisor's overall anti-fraud obligations under the Advisors Act, under Section 206 of the Advisors Act. So there is an obligation there, to ensure that those recommendations are proper, even though there hasn't necessarily been an advisory relationship that's arisen yet.
amazing analysis. Thank you, Isa. This is super, super timely given the types of cases we're seeing. Aaron, advisors are often wrestling with that question. How do I enhance my offering to my investors? How can a firm walk that line between that expanded offering, or somebody already sort of articulated better than that, the overall fit? And how do you do that at scale at a respective firm like yours?
Sure. So I think there's a couple of concepts that we're talking about here. So number one, we're talking about conflicts, mitigating conflicts, whether it's increasing, the products that you offer due to a new contractual relationship or a formal affiliation. We do offer products from our affiliates to our retail customers, and it's having those right controls in place within your compliance program to address and mitigate those conflicts, even if you're disclosing them. I think it's also using data. So I mentioned this before, the importance of data, particularly with respect to this topic. Having the data at hand and understanding what it is that you are offering to your clients, having, you know, a roadmap, so to speak, of those products and the risks associated with them, and perhaps coming to an agreement within a governance setting as to, as a firm, we feel that this set of products is appropriate for these types of customers who meet these types of profiles, and then setting up the right controls to ensure that your financial advisors and your investment professionals are, you know, aligned with the principles that you have set out. I think it's a lot of good controls overall to just summarize, but I think it starts with analysis and data and understanding your risk appetite and what you feel as a firm is best for your clientele based on who they are and understanding their needs. And I think, you know, one of the questions that we received is, you know, about the clone ETFs and the mutual funds. Is it appropriate to just remove the clone ETFs from your product base and disclose away? Well, I think that depends. You know, if it was this firm, we'd probably do a back test and apply those products to different profiles and see how it performs over time versus the mutual fund. And perhaps you do decide to say that that's not what we really want to offer our clients, and here's why, and disclose that at that time you're not offering, you know, the clone ETFs. You're going to choose to offer the mutual funds, and, you know, have a discussion with your financial professional.
Fantastic insight, Aaron. I mean, the concept of just removing clone ETFs altogether is somewhat challenging, I'll say, sort of as a vendor and someone who's worked on the technology side of this, because there is no flag out there in the clone ETF market that says, hey, I'm a clone ETF. And so in principle, that problem over time, as clone ETFs have become more and more popular, and they're going to become more and more popular over time, is going to be a growing challenge for firms on the product recommendation side. So I think that whole issue of product recommendations holistically and the consideration of available alternatives, that principle needs to be looked at holistically, whether it's being done, again, at the firm level or downstream within the advisor's purview of identifying available alternatives. And that's totally where technology can come in and say, hey, you've looked up product X, here's 5, 6 different options. Why reinvent the wheel? Why even put your firm or financial professional in that sort of predicament of trying to figure that out on their own in a manual process? So I did want to kind of keep that in mind. Now, you know, within the account switches, just coming back to it, there was this notion that the investors were not aware that the costs of these additional services or these accounts were going to be going up. Isa, would disclosure alone suffice in that circumstance?
Yeah, I mean, it was an important factor in that case, right? That the clients didn't receive, you know, full and fair disclosure regarding, you know, the fact that, you know, when they were being switched to an advisory account, there were, you know, there was going to be the imposition of an ongoing advisory fee, right? And you know, I think that what that gets to though is kind of like a, you know, kind of like the um I think what the SEC is hoping kind of would be like a back and forth between, you know, the firm or the rep and the client, right? You give the client the information, right? They fully and fairly understand it, and at that point, they kind of clearly state their intentions. Yes, notwithstanding this additional fee, um, I would like these ongoing advisory services because I see value for money associated with them, right? Whereas, you know, maybe you put that fee in front of somebody and they say, well, you know, okay, maybe the service that you're offering here, it's just not worth that amount of money to me. But the number one thing is transparency, right? The SEC was looking for transparency in those circumstances, and you know, there wasn't a level of transparency that would have given, you know, given rise to that indication by the retail client on a fully informed basis what services they would, they were requesting. Um, so, I think kind of goes hand in hand, the disclosure with kind of those overall kind of care obligations. The expectation is that by giving, the retail client the right disclosures, they can make a fully informed, indication or statement of interest as to what they're looking for, whether it's an ongoing advice relationship or not.
Hang on. I gotta share this because it's something that on the account type recommendations came up quite several years ago. One of our clients was going through an exam, a FINRA exam, and they were basically being asked questions on, well, what are you doing on account type recommendations, specifically switches from brokerage to advisory accounts? And at the time that it in a way, this is going back several years, it did come across as, deer stuck in headlights. What are you talking about? We conduct suitability analyses and we have supervision processes. When did account type recommendations really hit the regulatory purview? And the response they got back is, guess what? Given Reg BI, given the holistic nature of best interest and the care obligation, it is now sort of something that's going to be considered from the investor's best interest lens perspective. And so that's pretty much the background and the story behind our application being in market, and to help that advisor identify that fit upfront in the process without creating too much friction. Now, jumping back into this, and I'm mindful of time and the promise to jump into audience Q&A. It's phenomenal how fast time goes. Armin, maybe I can ask you one more quick question, and we've got one more case to cover. Given what we are seeing and the elevated pressure, what do you think firms can do to balance commercial objectives and their compliance obligations?
Yeah. I mean, I think generally speaking, there's a couple of simple things that we can do. And I mentioned one earlier, which was just be cautious when there's bulk transfers happening. I think that's an area where it's okay for a bulk transfer to happen, but then you have to have a plan in place to address it after the fact. I think the fees are obviously a theme that we're seeing in all of these, because ultimately the regulators are concerned that the clients are paying more than they should be. And it's important to just understand, when an account switch occurs, there is an analysis that has to take place, and it needs to be meaningful. And it needs to be a good review of the account, and really take into consideration, how the fees fit into this thing. And I'll give an example. If you've got a client who has maybe two or three different types of stocks. Let's say they inherited IBM or a few other things from their grandparents, and they're just holding those. And you do an account switch, and all of a sudden that client is having to pay an advisory fee based on the assets under management, when there's really no management happening in that account, right? I think that's the kind of stuff that we just need to be careful of. It's so easy for something like that to slip through the cracks. And so this is where we really have to take the time to evaluate each one of these things, and really have a lot of this goes on educating the IERs who are meeting with the clients, so that they know what to look for, and they're really the first line of defense in those things. So just really understanding what that is, and then making some good practical decisions, right? If it's just a few stocks, there's really not going to be any kind of investment management happening in that account. It just merely switched from, let's say, a brokerage account to an advisory account because the client wanted to stay with the advisor. I think it's a really good opportunity to not charge a fee on that account, and just let it be, and maybe just charge the platform fees or whatever it might be, but don't charge an advisory fee, and do right by the client in those situations. And I think alternatively, if there is a strategy in place and there is a intention to sell those securities and reinvest in in a variety of other securities, have that plan in place and execute it in a timely manner. So that we're not sitting, the clients paying a, advisory fee on those 2 or 3 stocks for an extended period of time. So I think those are all really, really, big things that we can do. And I would say just not having good policies and procedures is always a concern as well. It's not something that, we necessarily think about, but it is obviously, this is something that's on the regulator's radar. So we should be developing some processes and policies around, what happens during this type of a scenario. And lastly, I would say none of this happened unless you document it. And that's the biggest part. So we have to document. And whether you want to do an old school way of just keeping notes in your CRM, or you want to use, a tool that allows for the easy review and documentation and aggregation of all the data so that you can easily report. Lots of technology out there that can help you do this, and it's not that expensive, and I promise it's cheaper than the cost of enforcement. So yeah, that's what I would say about that.
Thank you, Armin, and I appreciate you saying that in a timely manner, given that where we are, and my promise to take up questions if we could. Clearly, there's a lot of interest in this area, and we've addressed some of the questions on the fly, but a few really key questions were asked up front that I wanted to spend a few minutes talking about it. So our lovely panelists it's a lightning round of Q&A. Jump in when you can. We got a question from Joe. With the reduction of staff at the SEC, have you seen any, or do you expect a slowdown in terms in audits being announced? Any areas that you think that firms need to abandon with respect to inquiries or audits?
I've seen firsthand an ongoing SEC examination significantly slow down and switch from one examiner to the other because the examiner at the onset of the exam took the retirement package. We have not heard back from the office in quite some time.
There you have it, folks. Any other thoughts or panelists?
I mean, obviously there's a lot of turmoil, at the SEC right now. And things, going to take some time to kind of shake out, and there are going to be different priorities from this administration. But, I'll overall say, you know, um, there are kind of resources within the SEC that are probably going to be reallocated in light of different priorities, right? I'm sure there were a lot of people, for example, who were, tasked with, enforcing kind of crypto matters, who are not going to be so busy on those matters anymore, but maybe they're going to be reassigned to different things. So I wouldn't necessarily kind of assume that just because, there's maybe a reduction in staff that they can't kind of fill gaps other ways. And then I'll also say, there are plenty of examples of, instances of kind of, tough regulation that have come up under, um, you know, administrations like this one, right? Reg BI um, you know, was not from the Gensler administration; it was from the Clayton administration. Same with the SEC's, investment advisor marketing rule. So don't discount the fact that um, you know, that regulation can still happen and it can be, significant. It's just that, the regulation might just have kind of a different kind of priority or angle to it.
Thank you, Isa. Look, 1 minute left. Maybe I can jam one question in, and it's an important one, given that we were talking about account fit or the investor's fit for the particular account. There's a particular question here that says, what would you consider to be frequent trading, quote unquote? And I'm assuming that relates to advisory accounts.
Yeah. I would say overall, like I would look back to, prior guidance and prior, SEC enforcement in the context of the suitability of wrap accounts, for some helpful suggestions, and just kind of off the top of my head, I would say it's not necessarily the case that there's an expectation that every account or every account that's in advisory has to be, constantly traded or, traded every quarter or something like that. But at a minimum, I think there's an expectation from the regulators that, um, that there is some level of attention to each account on an ongoing basis to determine whether it makes sense for, the account to be repositioned in any way to kind of meet the client's stated objectives. And, if those meetings and those discussions aren't happening, that kind of puts a lot of doubts around whether advisory is in the right, is in the best interest of that particular client. And I'll also say just in general, a low trade account um, is something that, should, according to kind of like your own internal policies and procedures, you know, over time, just kind of be subject to review, right? You should, if to the extent that an account is not, an advisory account is not traded for a certain amount of time, I think the regulators would have an expectation that, you're kind of following up with those reps and asking, well, what's the deal with this account? Is there a good explanation for why, this account has not been traded in a significant amount of time?
Thank you, Isa. And also, huge thank you to Aaron and Armin for sharing your insights and spending a few minutes with us. Um, we love feedback following the webinar. You're going to get a prompt pop up on your interface where you can provide us with feedback and indicate if you'd like any of these assets that we've talked about today. In addition, as always, thank you for spending a few minutes of your afternoon with us, and have yourselves a great day.